The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. My name is Ed Lyon. I'm partner in charge of content at Tax Coach Software, and I want to welcome all of you to today's discussion of Section 105 plans after Obamacare. I'm going to apologize in advance because this is going to be a very technical discussion, probably the most technical discussion that we've hosted here at Tax Coach in the 9 years since we've been in business. But there is a lot of confusion out there about 105 plans. There's a lot of misinformation floating out in the cyberspace and in the world. And there are a lot of opportunities that many people are not aware of to continue to use Section 105 plan to manage your employees' benefit needs if you are an employer, and to manage your clients' employee benefit needs if you are a tax professional, a financial planner, or a benefits professional. We do have a lot of new attendees here on their first Tax Coach call. Did quite a bit of marketing, and there was discussion here on LinkedIn and some other professional forums. So I'm actually going to start the presentation with a poll. I would just like to know, those of you on the call, what is your primary business? Would you describe yourself as a tax professional, as a financial planner, or as an employee benefits health insurance specialist? That'll be helpful information. Okay, we've got about 78% voting here, and I'm going to go ahead and write this down for my own records, but looks like about 65% tax, 12% financial planning, and 22% employee benefits. Thank you. I appreciate that. Appreciate you sharing that with me. All right, what I want to do today is start by discussing the basics of the Section 105 Medical Expense Reimbursement Plan. This is material that many of you may be familiar with. It may be new material for some of you. And if you are already familiar with the material, I apologize, because I want to make sure that we all are on common ground. Then I'm going to jump into the specific issue that has really upset the Section 105 plan world, and that is IRS Notice 2013-54, which was issued on September 13th of last year. So let me go ahead and start with the basics. A Section 105 plan is simply an employee benefit plan that lets an employer reimburse their employees for medical expenses they incur for themselves, their spouses, and their dependents. It is a core strategy for making health care more affordable by letting employers and employees use pre-tax dollars to buy their health care. This is not a new law. Section 105 has been in place since 1954. It's older than most of us on this call. And there's not a whole lot of controversy or case law on the basics of a Section 105 plan, because it really is pretty straightforward. So the first requirement is that it be an employee benefit plan. If you are self-employed, you cannot be a participant in a Section 105 plan because you are not considered an employee. To set up a Section 105 plan, somebody has got to be an employee. Now, in the typical Section 105 plan, as established by Tax Coach members for their clients, the client is self-employed, typically operating their business as a sole proprietorship. And a sole proprietor is not an employee. A sole proprietor is considered self-employed. So the standard strategy for establishing a Section 105 plan is to hire the spouse. So husband works as a self-employed real estate agent, insurance agent, financial planner, welder, plumber, consultant, whatever it is they do. They're operating their business as a sole proprietorship or as a single-member LLC that is disregarded for tax purposes. He hires his wife. His wife becomes the employee, and he then pays benefits through his wife. This can also work if you operate your business as a partnership or a limited liability company taxed as a partnership. A partner in a partnership entity is not considered an employee. However, he can hire his spouse if she is less than a 5% owner. With an S corporation, it gets a little tricky. You cannot be considered an employee of your own S corporation for purposes of this rule. So for the S corporation, 2% shareholders and their spouses are treated specifically as self-employed. This is in Internal Revenue Code Section 105 itself. And if you are operating your business as a C corporation, you can go ahead and hire yourself. The C corporation is not a pass-through entity, so you are considered an employee of your own C corporation. Now that creates problems with the S corporation, and a lot of Tax Coach members will have a client, a prospective client who is a sole proprietor. They see an opportunity to save money for the client with the Medical Expense Reimbursement Plan, and also by setting up another entity, typically an S corporation. Those two goals are contradictory. So if you're going to see it, generally it will save more for your clients to set up the S corporation than to set up the Medical Expense Reimbursement Plan. If that is the case, you have a couple of options. One is to restructure their business so that some portion of their income comes to them outside that S corporation. Maybe they have an S corporation and a C corporation and hire themselves to work for the C corporation. Maybe they have an S corporation and keep some income through a sole proprietorship and hire the spouse through the sole proprietorship. The other option is to look at structuring a health savings account policy, which will give much of the same benefit as a medical expense reimbursement plan, though not all. So our first hurdle is this is an employee benefit plan. Somebody's got to be an employee. Once we have an employee, now we can pay the benefit. And as I mentioned at the top of the hour, the 105 plan lets the employer reimburse the employee for medical expenses they incur for themselves, their spouses, and their dependents. This is a great strategy to avoid the 7.5% or 10% floor on deducting medical expenses from adjusted gross income. It also avoids self-employment tax. So, I'm a real estate agent. I make $80,000 a year on my Schedule E or on my Schedule C. My wife helps me operate my real estate business. I hire her as an employee. I don't even have to pay her a salary. The rules specifically provide that you do not have to pay a salary. So I don't have to pay my wife a salary. I don't have to worry about payroll. I don't have to worry about a W-2 at the end of the year. I choose to pay her in the form of benefits, and I'm going to compensate her in the form of a medical expense reimbursement plan. It will reimburse her for all expenses she incurs for herself, her spouse, which of course means me, and our children, our dependents. That will reduce my taxable income. It will reduce my Schedule C income, so it will reduce the self-employment tax I pay. And since I am deducting those expenses as an employee benefit on Schedule C, I don't have to worry if those medical expenses exceed the 10% floor or the 7.5% floor for those above age 65. Neat trick. The best part is this isn't like a 401k where I have to commit cash flow to a benefit. I don't have to put $10,000 of new money into a 401k to get a $10,000 deduction. This is money that I'm already going to spend, whether I get the deduction for it or not. I'm simply taking it from a place on my tax return where I probably don't get to deduct it and moving it to a place on my tax return where I do get to deduct it. So it's a great strategy. Eligible expenses, pretty much anything that you would want to write off as a medical expense. So insurance, I can deduct major medical insurance, long-term care insurance, Medicare Part B and Part D premiums, and even Medigap supplemental insurance. I can deduct all my co-pays, my deductibles, my prescriptions. I can deduct expenses like dental, vision, and chiropractic that often are not covered under traditional major medical policies. A lot of families don't have their own dental insurance. Well, I can write off my dental expenses on my 105 plan. A lot of families, most self-employed people don't have vision coverage in their insurance. Well, I can write off my eyeglasses and my contacts and my vision expenses through my Section 105 plan. Chiropractic benefits are sometimes limited as well. I can write off really big ticket items like braces for my kids' teeth, LASIK treatment for my eyes, fertility treatments, and even special schools for learning disabled children. I can write off over-the-counter medications and supplies if they are actually prescribed by a prescription. Someone on the call asks, will this also cover medical mileage? Absolutely. Anything that would be deductible under Code Section 213D. My favorite deduction of all time is eligible under the Section 105 plan, and that is voodoo animal sacrifice. And if you're new to tax coach, you're probably chuckling right now, but bear with me, this is a legitimate deduction. The tax court has said you can take a deduction for Christian Science practitioner fees and also Navajo Indian medicine man fees. So, under the same logic, your voodoo animal sacrifice is a deductible medical expense as long as it's part of a religious ceremony for healing purposes. Hey, besides, do you want to tell the voodoo queen she can't deduct her chickens? I did not think so. All right. There are some pretty stringent non-discrimination rules that may limit how much you can use a Section 105 plan if you have non-family employees. The plan must cover all eligible employees. Now, you can exclude some categories of employees from eligibility. You can exclude employees who are under age 25. You can exclude employees who work less than 35 hours per week. You can exclude temporary employees, seasonal employees, those who work less than 9 months per year. You can exclude employees who have less than 3 years service with the employer. In other words, you can impose a 3-year waiting period. And you can exclude employees who are covered by a bona fide collective bargaining agreement. Now, I'll confess, I never used to pay much attention to that collective bargaining agreement provision. After all, private sector unions are on the wane in the United States, for better or for worse, and this isn't the place to have that discussion. However, I have seen a growing number of attorneys and other benefit specialists who will work to create a collective bargaining unit within a small business. These same non-discrimination rules for collective bargaining also apply for pension plans. And what that means is a small employer who packages his employees into a collective bargaining agreement can set up one set of medical benefits and pension benefits for the employees of that collective bargaining agreement and a different, presumably more generous set of benefits for employees not in that collective bargaining agreement, presumably limited to himself or herself. So, the 105 plan is also subject to the same controlled group rules that apply to qualified retirement plans and the same affiliated service group rules that apply to qualified plans. This can get a little tricky. So if I am a partner in a business. Let's say my partner Keith Vandestad and I are operating Tax Coach as a partnership, and I own a third. We've got a third partner, Lisa. So let's say I own a third, Lisa owns a third, and Keith owns a third. Well, I can set up an S corporation, or I can set up an entity to own my interest in Tax Coach, and I can set up a 105 plan for myself because I'm not covered by the controlled group rules. And that's because we don't have the common ownership. I only own 1/3 of that entity. However, the affiliated service group rules say that if I derive more than 50% of my revenue from another entity, then the affiliated service group rules kick in, and in fact, I cannot set up a 105 plan for myself without setting up a 105 plan for the affiliated service group, which would include all of Tax Coach. So there are some non-discrimination rules. If you or your client want to cover yourself, that's great. Just understand that you will probably have to cover non-family employees as well. That may be a problem, that may not be a problem, depending on how you want to structure it, and we will talk about that in a little bit. Okay, the paperwork. Into each life a little red tape must fall. And naturally there is some paperwork associated with the 105 plan. You do need a written plan document. The benefits that you pay under the plan must be reasonable compensation for the work the employee provides to the business. This becomes an issue in the hire your spouse scenario. Let's say I'm a real estate agent, my wife works for my business, and she works 1 hour per quarter stuffing envelopes for a mailer. So 4 hours per year. Now I want to do a medical expense reimbursement plan, and I want to pay for LASIK surgery that's going to cost $4,000. If this plan ends up in an audit, is the IRS going to think that $4,000 of LASIK surgery is reasonable compensation for the 4 hours that my spouse puts into working for my business? I don't know. Maybe my wife is really, really good at stuffing envelopes, but I'm going to have a queasy feeling in my stomach if I try to defend that arrangement to an auditor. But it is important that the benefits be reasonable compensation. You also must be able to verify bona fide employment. So you can't merely call your spouse an employee if you can't verify that the spouse actually works for the business under the direction of the owner. And this has come up in a couple of tax court cases examining Section 105 plans. You must be able to document that payments are made from the business in order to deduct those payments from the business. If you're doing a Hire Your Spouse 105 plan, you cannot simply total up the family's medical bills at the end of the year and move that figure from Schedule A to Schedule C. You've got to show that payment for those expenses came out of the business. Now you can do that a couple different ways. You can have the employee document those expenses and submit reimbursement to the employer and show money coming from the employer to the employee, or the employee can submit premium notices and other bills to the employer and have the employer pay those expenses directly. It doesn't matter which way you choose, but it is important that you document the payments come from the employer, or again, at audit, those expenses are going to be disallowed. Do you need to have a third-party administrator? There are a couple of national services that will help small business owners set up a 105 plan for a fee, usually in the several $100s range. They may pay a commission to an accountant or a financial planner who refers them to those clients. Then they will, quote-unquote, administer those plans for the clients for another fee, typically in the $150 to $300 per year range. Is it necessary that you have a third-party administrator for the plan? No, it is not. There is a requirement that the employer certify the payments that are made to be allowable under the plan. And the regulations provide that an employee may not certify their own payments. However, the employer, let's say it's the spouse, can certify those payments in their role as an employer. It is not necessary that you have an ongoing third-party administrator relationship. Now, having said that, many Tax Coach members will offer to administer the plan, essentially to account for the expenses in the plan, and then take those expenses when they prepare the tax return for the client. They do not need, however, to act as a licensed bonded third-party administrator to do that kind of work. Finally, there is something that came as a last-minute surprise to a lot of 105 plan sponsors and their professionals last year, and this is the PCORI, the Patient-Centered Outcomes Research Institute fee, and a Section 105 plan as of 2012 owed a whopping $1 per participant fee, which had to be filed with an excise tax return and paid by July 31st, 2013. That came as a surprise to a lot of people. They learned about the fee. They decided whether it was worth paying or not paying. Safety says you go ahead and you file the tax return. Frankly, what I did for one client was we filed the return. We didn't actually send the dollar because we were curious to see if the IRS would ever bill the client for the dollar. And as far as I'm aware, there has been no bill forthcoming. But don't laugh at that PCORI fee, because for plans ending in 2013, which will be reported in 2014, that fee doubled to a whopping $2 per person. So be aware of this pesky Patient-Centered Outcome Research Institute fee. Don't lose sleep over it, but this is one of those pesky things that you need to do to dot your I's and cross your T's. Let's talk now about how to use Section 105, because lots of employers use Section 105 in a lot of different contexts. And there are really two ways to do it. You can use Section 105 as a standalone, or you can use Section 105 as a wraparound to wrap around an additional health insurance policy. So an employer who uses Section 105 as a standalone can do it as a fully self-insured plan. The biggest private health insurance plan in the United States is General Motors. And you may not realize it, but General Motors' health plan is just a Section 105 plan. It's a plan that lets General Motors, the employer, reimburse all thousands and thousands of their employees for medical expenses that they incur for themselves, their spouses, and their dependents. And General Motors is a large enough employer that they can take advantage of the law of large numbers, and rather than go out and buy insurance on their employees, rather than go out and pay an insurance company admin fees and profit to administer the risk, General Motors can know pretty much how much an employee is going to cost. They don't have to lay off any risk. They can go ahead and they can go ahead and just pay the benefits directly, cut out the insurance company middleman. And in fact, big three automakers have bought their own hospitals, bought their own medical practices. Their plans really are standalone. Now, for a typical self-insured employer, you're not going to pay all of those expenses yourself. A typical self-insured employer is going to assume risk up to a certain amount, and then they're going to buy stop-loss insurance so that a runaway disaster, a birth defect, or a horrific accident or an expensive cancer doesn't end up costing them $1 million or more for an employee. So your typical self-insured plan with a company of, say, 300 or 400 employees, it's really not self-insured. There's a stop-loss. Maybe it's going to be $10,000, $25,000. Typically, it'll be $50,000 or $100,000 per employee. And what that means is that the employer is taking on a significant amount of risk. If you've got 300 employees, if you've got 200 participants in the plan and a stop loss at $50,000, you, the employer, are taking on 200 times $50,000 worth of risk. You're taking on $20 million worth of risk. Now, realistically, we know that not all 200 employees are going to hit that $50,000 worth of risk. But this is the kind of thing that keeps benefits officers up at night, worried about the risk. So a new category of self-insured plans, standalone plans, has looked at this concept of stop loss and said, hey, wait a minute. The concept is we self-insure a certain amount of risk and we get a stop loss. But why do we have to get a group stop loss policy for $50,000 per employee? Why can't we limit our risk and possibly lower our costs by buying more traditional health insurance, maybe with a $5,000 deductible or a $10,000 deductible on our employees? And as health insurance, as group health insurance has gotten more and more expensive, I've seen a growing number of employers say, you know what, I want to get out of the group health insurance business entirely. I'm tired of having to pick group health insurance policies for my employees. I'm tired of getting the good newsletters from my agents saying that my premiums are going up 15 or 20 or 30% per year. I'm tired of having to whittle away at deductibles and gradually assume more liability. I'm tired of having to charge my employees more and more for their insurance every year. I don't want to have to pick a group policy because that means I'm picking a network, and I don't want new employees who come into my group to not be able to cover their children with their favorite doctor, their local dentist. Why don't I get out of the group health insurance business entirely? Why don't I just use Section 105 to set up an allowance for my employees to go out and pick their own insurance? And heck, with Obamacare, now we've got this whole new way to buy insurance. We've got insurance exchanges. We've got facilitators who are helping consumers become smarter health insurance buyers. Why not do that? And guys, not a week goes by that I don't get a Tax Coach member coming to me and saying, I have a client who wants to get out of the group health insurance business. Can I do that? And up until IRS Notice 2013-54 came out, the easy answer was yes, that's a great idea. We'll talk in a little bit about how the IRS Notice has complicated that. The other way that employers use Section 105 is as a wraparound plan. They will either build on group health insurance or build on individual health insurance and use the Section 105 plan to cover expenses that the insurance itself does not. So let's say you have an employer, he's a tool and die shop, he's got 30 employees, and they're covered by a traditional health insurance plan. Traditional group health plans have generally low deductibles, maybe in the $500 to $1,000 range. That's the plan that's getting more and more expensive every year. Well, why pay the insurance company to administer those claims and take that quote-unquote risk on what is really not a whole lot of risk? So I have worked with a number of benefits professionals and tax professionals across the country to go to these employers and say, hey, Mr. Employer, here's an idea that'll save you money on health care. You're paying a lot of money for a pretty nice health insurance policy, but what your employees really want is a benefit. They don't care how the health bills get paid. They don't care if you pay it. They don't care if Anthem pays it. They don't care if Humana pays it. They just want it paid. So let's do this. Instead of buying that really expensive group health insurance policy, let's switch to a high deductible policy. That's going to cut your premium maybe in half, maybe by 2/3. It's going to save a lot of money. Now here's the downside. It's not going to cover as much benefit. So your employees are going to be unhappy. But what we're going to do is we're going to set up a Section 105 plan, a medical expense reimbursement plan. And we're going to use that 105 plan to cover the difference between the old insurance that you are buying and the new insurance that you are buying. Basically, what we're going to do is we're going to carve out the difference between the old plan and the new plan, and we're going to cut out the insurance company middleman. We're going to cut them out completely for those dollars. We're going to administer them for you. We're going to find a third-party administrator who can do that for you and comply with all the regulations, because you don't want to get in the business of managing a health plan. And you're going to save a boatload of money, because the fact is most employees aren't going to hit that deductible even for the new health plan. What you're going to do is you're going to buy real insurance, and you're going to pay for your own dollars administering the small claims. And by cutting out the insurance company middleman, you cut out the insurance company's admin, the insurance company's profit. You are even, unfortunately, going to cut out part of the insurance agent's commission and bonuses or override. Now, you can imagine that insurance companies don't like this strategy. In fact, some insurance companies get hopping mad over this strategy. If you're the middleman, do you want to get cut out? No, of course not. But employers who may otherwise be loyal to an insurance agent or an insurance company simply can't afford to pay the higher premiums. Insurance companies have fought back. In California, for example, Anthem says in their agent handbook that they will consider that they reserve the right to terminate the contract of any agent who moves a group to a higher deductible plan in order to set up this sort of a wraparound arrangement. Now, I'm going to go out on a limb here, because I'm a cynic, and I'm going to say that if the insurance companies don't like it, it's probably a good thing for the employer and the employee. But that's just me. I am a little more cynical. You can also use a 105 plan to wrap around an individual policy. So, back to the example where I'm the real estate agent earning $80,000 and I'm hiring my wife. I don't want to use the 105 plan to cover all my medical expenses. I still need health insurance, but I don't want to pay a ton for my health insurance. So what I can do is I can go in and I can buy a high deductible health insurance policy. It can be an individual health insurance policy on my wife. Then with the 105 plan, I will pay the premiums on that policy, and I will pay the unreimbursed expenses on that policy. And together, I will lower my overall cost for health care by A, lowering the absolute cost, and B, making it all tax deductible. My wife doesn't even have I don't even have to buy my wife's own health insurance. Let's say I'm the self-employed real estate agent and my wife works for the local waterworks, and she has a health plan through the waterworks. Well, even a good health plan is not going to cover every single dollar of health benefits. So I can hire her to work for my business, I can pay her in the form of benefits, and I can use the 105 plan to write off what her plan does not already cover. Great strategy, because if I didn't have the 105 plan, now I would be deducting those on Schedule A, and the 10% floor on medical expenses would probably mean that I don't get to deduct anything. So, lots of ways to use Section 105, either as a standalone plan or a wraparound on group or individual insurance. And such it was until Obamacare came along. Now, Obamacare imposed two requirements that specifically apply to the 105 plan and that have employers and employees worried. The first are the market reform provisions. You can't sell crappy health insurance under Obamacare anymore. Well, that's not entirely true. When Obama was stumping for the law, as you all know, he said, if you like your plan, you can keep it. Then we found out last year that that wasn't entirely the case, that if you liked your plan but it wasn't good enough under the new Obamacare requirements, you had to get rid of it. You had to get better coverage to meet the individual mandate. And the Obama administration extended the deadline for getting rid of those plans for 1 year. They announced earlier this week that they were extending that deadline another 2 years. A cynic might look at that and say, that means that nobody has to get rid of their plans before the next midterm election in November of 2014, and might question the motives, but that would be only if you are cynical. The market reform provisions say that a plan can no longer impose annual limits on benefits. It can no longer impose lifetime limits on benefits, and in fact cannot turn anyone down for pre-existing conditions. We also have the individual mandate. That's the most controversial part of Obamacare, which says that you must have minimum qualifying coverage or be subject to some specific tax penalties. I'm not going to go into those in any detail because, as we'll soon see, you can satisfy the individual mandate with the 105 plan. All right. Now, let's talk about this IRS Notice 2013-54. And if you look at your screen, you see that IRS Notice 2013-54 has become the big bad wolf. And the big bad wolf is going to huff and puff and blow Section 105 down, right? Well, not so fast. Let's take a look at Section Notice 2013-54 in some pretty excruciating detail, and let's see what it does not do, and what opportunities may be left over for you. So, first of all, if you have not read Notice 2013-54, I urge you to do so. You're going to be scratching your head the first 3 or 4 times you read this. I've got to say, it is the most poorly written attempt at guidance I have seen in my 20 years as a tax JD and here at Tax Coach. It is a hot mess of a notice. But let's walk through some of the specifics here and talk about exactly what it does and does not. First, let's talk about the scope of authority. And what I've got here is language from CCH's website explaining the scope of authority. We've been talking for the last 40 minutes about Section 105. That's Section 105 of the Internal Revenue Code. That is the law of the land. It was passed in 1954 by Congress, signed by President Eisenhower, and remains the law of the land. Does Notice 2013-54 overturn Section 105? Absolutely not. What's the scope of authority? Generally, the IRS issues notices and announcements to provide substantive or procedural guidance on an expedited basis with respect to matters of general interest that would otherwise be covered by a regulation, revenue ruling, or revenue procedure. A notice is a public pronouncement that may contain guidance involving substantive interpretations of the Internal Revenue Code or other provisions of the law. For example, notices can be used to advance the IRS's position in situations where regulations are still in the drafting phase and have not yet been released. As such, IRS notices are often very authoritative and the only guidance available on a particular tax issue. A taxpayer may rely on a notice or announcement to the same extent as a revenue ruling or revenue procedure. But let's pay attention here. Notices can be used to advance the IRS's position in situations where regulations are still in the drafting phase and have not yet been released. This IRS notice is the Internal Revenue Service's interpretation of the effect that the Affordable Care Act, or Obamacare, has on Section 105 of the Internal Revenue Code. IRS Notice 2013-54 does not repeal Section 105. It does not overturn Section 105. It does not modify Section 105. It does not rewrite Section 105. It is the IRS's interpretation of Section 105. All right. Now let's take a look at the specifics that Notice 2013-54 cover. And the most important here is the no annual limit rule. Remember, I said a few minutes ago the market reform provisions of Obamacare state that a health plan may not have annual limits on benefits. And in fact, IRS Notice 2013-54 states a group health plan or a health insurance issuer offering group health insurance coverage may not establish any annual limit on the dollar amount of benefits for any individual. That seems pretty straightforward. A health plan may not establish any annual limit on the dollar amount of benefits for any individual. Okay, fine. Now, let's look at the definition of an HRA, a health reimbursement arrangement. This is important in IRS Notice 2013-54 because it talks about the intersection between health reimbursement arrangements and the Affordable Care Act. An HRA is an arrangement that is funded solely by an employer and that reimburses an employee for medical care expenses as defined under Code Section 213, incurred by the employee or his spouse, dependents, and any children who, as of the end of the taxable year, have not attained age 27, up to a maximum dollar amount for a coverage period. The emphasis, the bold, the italicizing, that is mine. Pay attention. Up to a maximum dollar amount for a coverage period. This reimbursement is excludable from the employee's income. Amounts that remain at the end of the year generally can be used to reimburse expenses incurred in later years. HRAs generally are considered to be group health plans within the meaning of Code Section 9832 of ERISA and the Public Health Service Act and are subject to the rules applicable to group health plans, blah, blah, blah. Notice the language. An HRA is an arrangement funded solely by an employer to reimburse employees up to a maximum dollar amount for a coverage period. Now, this is different from what the IRS calls an employer payment account. Some of you may call this a health reimbursement account or a premium reimbursement account. Revenue Ruling 61-146 holds that if an employer reimburses an employee's substantiated premiums for non-employer sponsored health, hospital, and medical insurance, the payments are excluded from the employee's gross income under Code Section 106. We're talking about Code Section 106. This is not a Section 105 plan. This exclusion also applies if the employer pays the premiums directly to the insurance company. An employer payment plan, as the term is used in this notice, does not include an employer-sponsored arrangement under which an employee may choose either cash or an after-tax amount to be applied toward health coverage. And here, individual employers may establish payroll practices of forwarding post-tax employee wages to a health insurance issuer at the direction of an employee without establishing a group health plan if the standards of the DOL's regulations are met. You may have heard that list billing is dead. List billing is not dead. Under Notice 2013-54, the IRS acknowledges explicitly that individual employers may establish payroll practices of forwarding post-tax employee wages to a health insurance issuer at the direction of an employee. All right, now let's get to the bone. Integration with individual insurance. IRS Notice 2013-54 walks through a series of questions and answers. Question 1, the health reimbursement arrangement frequently asked questions, which were issued in January, provide that an employer-sponsored HRA cannot be integrated with individual market coverage, and therefore an HRA used to purchase coverage on the individual market will fail to comply with the annual dollar limit prohibition. I think that's kind of silly. Basically what they're saying is that if an employer sets up a 105 plan to give employees an allowance to buy individual insurance, that will not satisfy the no annual limit rule. Why? Because there is a limit to the amount of benefit that is paid under the HRA. That's pretty silly, considering that the insurance they buy with the money from the HRA has no annual limits. It's kind of like saying that the no annual limit satisfaction doesn't pass through. Those of you who are tax professionals understand that when income passes through one entity to another, it retains its character. Passive income earned by a partnership passed through to a partner retains its character as passive income. Active income from a trade or business earned in an S corporation and passed through to a shareholder retains its character. Well, when it comes to health insurance, the health insurance satisfies the no annual limit rule. But if it's paid for through an HRA, it doesn't retain that character. Why? Because the HRA, as we specified back a couple slides ago, has a maximum dollar amount for the coverage period. So the HRA provides that an HRA used to purchase coverage on the individual market will fail to comply with the annual dollar limit prohibition. May other types of group health plans used to purchase coverage on the individual market be integrated with that individual market coverage for purposes of the annual dollar limit prohibition? No. A group health plan, including an HRA used to purchase coverage on the individual market, is not integrated with that individual market coverage for purposes of the annual dollar limit prohibition. So it fails the test. It fails the no annual limit rule. And if you're looking to buy your insurance on your own, if I'm the self-employed real estate agent, this would seem to indicate that I'm not going to meet the requirements of the individual mandate because my plan does not satisfy the no annual limit rule. Well, let's take a look. What about in that hire your spouse category? What if I have an HRA with just one employee, my spouse? Well, IRS Notice 2013-54 addresses this explicitly. Question 10, is an HRA that has fewer than 2 participants who are current employees on the first day of the plan year, for example, a retiree-only HRA, minimum essential coverage for purposes of Code Section 5000A and 36B? The answer is yes. A one active participant plan is not subject to the market reform provisions. So, the Hire Your Spouse 105 plan is alive and well because it fits within this exception. Now, how else can you integrate a 105 plan with individual insurance policies? Well, if I can figure out how to work PowerPoint here, let's go back to that definition of the HRA that IRS Notice 2013-54 discusses. An HRA is an arrangement, yada yada, up to a maximum dollar amount for a coverage period. If there is not a maximum dollar amount for a coverage period, then the 105 plan isn't an HRA for purposes of this notice. It's one of those solutions that's so simple that you're going to smack your head when you realize it. IRS Notice 2013-54 was the big bad wolf that blew down using HRA dollars to buy individual health insurance coverage. But you know what? The notice defines HRAs as plans that are subject to a maximum dollar amount for a coverage period. An HRA is not the same thing as a Section 105 plan. So you can still set up a Section 105 plan to cover your employees simply by lifting the maximum annual dollar limit. And I would suggest using language in the plan, something like what you have in front of you on the screen right now. This plan is intended to meet the market reform provisions of the Affordable Care Act contained in Section 2711 of the Public Health Services Act. Therefore, there shall be no annual limit imposed on the premium amount or benefit or whatever reimbursable under this plan. By including this sort of language in the plan, you now get rid of the problem that subjects it to the guidance of Notice 2013-54 in the first place. And now you are free to set up a plan that will reimburse your employees for their premiums. Given that employees can now buy coverage on an exchange or off an exchange that is guaranteed issue, you avoid the risk of the runaway health premiums. Employers will be nervous when they see language that there is no limit to the plan. They'll be nervous if they're talking about premiums, so you sit down with the employer and you look at what the actual premiums are going to be for the employees. That reassures the employers. If you're using a Section 105 plan to pay benefits in addition to health insurance premiums, well, you don't have to worry about that now either because you've got the stop loss. The insurance itself is the stop loss. Remember, when we talked about self-insured plans, we said that the typical self-insured employer will cover their employees, they'll pay the employees' expenses out of their pocket, but they'll buy a stop loss policy from an insurance company to cover the risk of runaway claims. Well, you can do the same thing now with a health insurance policy. You can, for example, pay for bronze coverage under an exchange, which is not necessarily the best coverage, but then you can have a Section 105 plan in place to cover the difference between the bronze plan and the employee's old plan. Here at Tax Coach, we're about to put a pretty extensive template plan document on the site for our members. That'll be going up later this evening or tomorrow. It's not going to be a simple fill-in-the-blank document the way you would use it with a Hire the Spouse 105 plan, but it's something that you can take to a benefits professional or an ERISA employee and use as a template for an overall health plan. So, are Section 105 plans dead? Did the big bad wolf huff and puff and blow down Section 105 plans? No, he sure did not. There are limits on a particular category of Section 105 plan. Those limits are pretty devastating, but using the Section 105 plan, not dead by any means. Using the Section 105 plan to set up an allowance to pay for insurance for your employees, not dead under IRS Notice 2013-54. All right, that's it for the explanation. We're nearly at the end of the hour, but I will be here until the cows come home for questions, comments, and discussion. Let me see what we already have in the queue. A couple people have asked if this webinar will be available for replay after. Yes, it will be available. We will be posting it on the Tax Coach website. A member says, I have a client who wants to cover his employees. He's a C Corp, but all he wants to cover is medical insurance acquired through the New York Exchange. Absolutely, he can do that, and the way he does that is with a premium reimbursement Section 105 plan that specifies that it covers the insurance and that there is no limit to the premium reimbursement. So that can be done. Another member asks, is there a maximum amount And is the benefit to be shown on the employee's W-2? No, there is not a maximum amount. As we've discussed, you really want to avoid having any kind of a maximum amount. As for the requirement that you report the value of health benefits on Form W-2, most employers are small enough that that requirement does not apply. I believe for this year it applies to employers with 250 or more employees. It may have gone down to 100. I'm not sure. Question: are spouses with an S corporation always considered self-employed and therefore cannot use a 105 plan for themselves? Unfortunately, that is the case. The rules provide specifically that a more than 2% shareholder and their spouse are both considered self-employed with regard to the 105 plan rules. The way to get around that is to segregate a stream of income that is paid outside the S corporation and structure a 105 plan through that segregated stream of income. Alternatively, if they're responsible for buying their own medical insurance, you can get most of the benefit by using a health savings account. All right. Great question here. Some employees under an individual policy may qualify for tax credits as a result of low income. Do tax credits affect the deductibility under Section 105? Actually, it's the other way around. The premium subsidies under Obamacare take the form of tax credits, and these are governed under Code Section 36. You look at the employee's income, you look at the amount of premium the employee pays, and you see if they are eligible for a tax credit. However, the rules do provide that an employee may not take a tax credit for premiums that are paid through an employer plan. And this throws a lot of uncertainty into the mix. It really creates planning opportunities, though. For decades now, the main government strategy to help people pay for expensive health insurance and health benefits is through tax deductibility. And in fact, tax-free employee health insurance has become the biggest tax preference item in the entire Internal Revenue Code. But a lot of employees really don't get much benefit from that tax deduction. They don't make enough money that they would be paying much money on the premium dollars anyway. Remember Mitt Romney's infamous 47% who pay no taxes. Well, if 47% pay no taxes, it stands to reason that 40% of Americans get no benefit from tax-deductible health insurance. Their employers still get a benefit by deducting the amount of premium they pay on the employer's behalf, but the employee gets no benefit. Now we've got a new strategy starting January 1st of this year for making health care more affordable. That new strategy is subsidies under the Affordable Care Act. So for a lot of employers, particularly with lower paid employees, the premium subsidy is actually more valuable for the employee than the tax deduction. So for a lot of employers, it's going to make sense to get rid of employee benefits entirely, get rid of benefit plans entirely, let the employees buy their own insurance on the exchange and benefit from the premium subsidy. They'll benefit more from the premium subsidy than from the tax deduction. Now, there's no pat way to know whether that makes sense or not. You really just have to look at the employer's demographics. But generally, if employees are lower paid to where they're going to get a significant tax credit, they will benefit more from the premium subsidy than the tax deduction. So it really is the other way around. Hopefully that answers your question. Member says, after all of that great explanation, what about the client who wants to pay a fixed amount as a reimbursement, say $100 per month through the 105? Well, unfortunately, that employer is hosed, because if you want to pay a fixed dollar amount, now it qualifies as a health reimbursement account. Now it's not just a generic Section 105 plan. So IRS Notice 2013-54 does shoot that down. In that case, you may want to work with the employer, depending on how many employees they have, whether they're going to be subject to the employer mandate for 2015 or 2016, depending on their size, you may want to look at how much the employees can benefit from the premium subsidies. But in a situation like that, where you want to pay a fixed amount as a reimbursement, I would simply add that fixed amount to the employee's paycheck. Yes, it will be taxable, but as we discussed a minute ago, it may be that the employee gets more benefit from the premium subsidy than they would from the credit. Another member asks, can a spouse be a silent owner? In other words, legal owner for banking and tax purposes, but not working in the business. Yeah, absolutely. A spouse can be a passive owner in a business who does not materially participate. And if that's the case, if their ownership is under 5%, they can be hired as an employee for purposes of the Section 105. But sure, an employee can be passive. Member asks, will this PowerPoint be available? Yes, we will make that available on the website at the same time that we post this webinar. Can an employer pay for all or a portion of the premium and the employee still be eligible for a premium subsidy? Yes, the employee is eligible for a premium subsidy if their coverage is not affordable. And by affordable, that means if it is more than 9.5% of the employee's income. And we're looking at employee-only coverage. So if I work for a company and an employer pays part of my coverage, I can still be eligible for a premium subsidy if I'm paying more than 9.5% of my income. However, the exchanges really were designed for self-employed people and for employees whose employers do not actually offer health benefits. Member says, any thoughts about the Classic 105 is an employee-funded medical reimbursement account? The allowable reimbursements are defined under Section 105B. Do you believe the IRS notice applies? Well, actually, the Classic 105 is an employer-funded medical reimbursement account. I'm going to assume that that's what you meant to say. An employer-funded medical reimbursement plan, the allowable reimbursements are defined under Section 105B. Do you believe the IRS notice applies? It applies if it is a health reimbursement account. Absolutely. And remember, this notice doesn't say anything about the traditional arrangement that we talked about under how to use Section 105. We talk about a wraparound built on group insurance, and we said that employers can replace their traditional low-deductible group health policy with a high-deductible plan, then set up a Section 105 plan to wrap around that group insurance policy. Well, nothing in IRS Notice 2013-54 prohibits an employer from using a 105 plan to wrap around a group health insurance policy. The specific issue is individual market coverage rather than group coverage. All right. Bear with me while I flip back to the questions. If an employer pays $200 towards the cost of a health insurance plan, they have a Section 105 plan to cover the deductible and out-of-pocket expenses, but the monthly premium is $325. Can the employee pay for the $125 excess premium cost with pre-tax dollars? In all likelihood, yes. The question is, where is that coverage coming from? If it is a group health insurance plan, then the employer can choose to pay $200 with pre-tax dollars towards the plan. The 105 plan, the employer 105 plan, would integrate with that insurance, and the employee can still pay for that $125 excess premium pre-tax. They would do that with a Section 125 POP plan. Okay. Member says, we put our employees on individual plans. We cover 97% of the premium, but also reimburse $1,500 or $3,000 in expenses. is this the limited HRA we need to get rid of in order to follow the 105 plan? Yeah, if you're going to do this as a Section 105 plan with individual health insurance, you really do need to get rid of the limit on the coverage. I don't know if you could have two separate 105 plans, one 105 plan unlimited that buys the individual insurance and another 105 plan with a limit that covers that reimburses the $1,500 or $3,000. I think to be safest, though, you probably need to get rid of the limit entirely in order to qualify as a Section 105 plan. I'm concerned that if you have a limit on the benefits, you are considered a health reimbursement account, and that is limited by this IRS notice. Is this strategy limited regarding the number of employees? From a practical sense, yes. From a statutory sense, no. This strategy is not limited according to the number of employees you have. However, remember, you have an employer mandate that kicks in 2015 for employers with more than 100 full-time equivalents and kicks in 2016 for employers with between 50 and 99 full-time equivalents. So yes, there will be an interaction with the number of employees. All right. So you're saying the concept of the pure defined benefit health plan, which purports to reimburse for insurance premiums up to $100 or $300 or some fixed dollar amount, is not allowed, correct? Because there's a maximum. You're specifically saying to buy bronze coverage, group or individual, and wrap around a Section 105 plan. Sorry for the long question, but you know which plan I'm talking about. Yes, I do. Unfortunately, the limited benefit, the limited defined benefit plan where you have a dollar limit, that is no longer allowed under Notice 2013-54. Now, remember, we talked a little bit about the scope of authority for the IRS notice, for IRS notices in general, about 20 minutes ago. It may turn out that the tax court or Congress or some other body with authority determines that this is the wrong guidance in the first place. But if you want to be ultra safe and remain within the limits of Notice 2013-54, yes, you want to avoid those sorts of limits. If an employer has a group health plan set up, but one of their employees does not qualify for their plan, is there a way the employer can reimburse the premiums of this individual? I'm not sure I understand the question, because I'm not sure why an employee would not qualify for their plan. If you could clarify your question for me, that would be helpful. What about an employer receiving a list bill and continuing to do payroll deductions after having employees go to the individual market, and pre-tax, post-tax implications? Well, they absolutely can do that. Now, they can do that with pre-tax list bill dollars with a Section 125 plan, or they can do that post-tax with list bill dollars not run through a Section 125 plan. The real issue is if they go on to an exchange policy, they do not qualify for premium subsidies if the dollars are paid for through a Section 125 plan. So you're going to have a couple of different scenarios depending on whether it makes more sense for an employee to get the premium subsidies or for an employee to get the pre-tax dollars. If all the employees make $30,000 a year, go ahead and have them buy their policies on the exchange with after-tax dollars. They'll save more with the list bill. But if your client is a law firm or a consulting firm and all the employees make $150,000, they're not going to qualify for the subsidies. So do a list bill with pre-tax dollars with the employees in that circumstance. Would you send me your website address? A member, somebody who's not a member says, a visitor, you can go to taxcoachsystem.com. If you're interested specifically specifically in Section 105 plans and administering Section 105 plans, we work with a highly qualified third-party administrator here in Cincinnati. To our knowledge, they're the only third-party administrator in the country who specializes in working with those plans. Their name is ClaimLinks, and their web address is ClaimLinks, ClaimLinx.com. And Tom Quigley is our contact at ClaimLinks. Again, as I said earlier, they are the only third-party administrator in the country that I'm aware of that specializes in working with these plans. TaxCoachSystem.com, ClaimLinks.com. How does the wraparound benefit get around the issue of integration where a group plan cannot be integrated with individual coverage? Well, that's the issue. If you're going to use a 105 plan for benefits that aren't covered by insurance, you either integrate them with a group plan or you integrate them with individual coverage which is bought through a Section 105 plan, not a health reimbursement arrangement. If the 105 plan does not reimburse health insurance premiums, can the 105 plan reimburse other medical expenses and include a limit on expenses? Yes, it can. Will this seminar be offered again soon? If there's enough demand for it, sure. Otherwise, it will be posted to the Tax Coach website for members to access. Is the PCORI fee required for an entity using a 105 plan even when the individual employee's insurance company is also paying this fee for the employee? Yes, the Section 105 plan is a separate entity which is subject to the excise tax from the underlying insurance policy, which may also be subject to the excise tax. Is a 125 plan something good to look at? I'm not familiar with them. Absolutely. A Section 125 plan is how an employee pays their share of covered premiums with pre-tax dollars. So most employers who buy group health insurance for their employees do not pay 100% of the premium. There's usually some kind of cost sharing required, and the employee has to pay that out of their paycheck. It's deducted out of their paycheck. What a Section 125 plan does, particularly a POP plan, which stands for Premium Only Plan, is it lets the employee pay those premium dollars with pre-tax dollars. Just to clarify my understanding, you could have a health reimbursement arrangement with an annual limit if you also have a group insurance plan, but not if you do not have a group policy plan. If you have a group but you have employees that elect not to participate because they have coverage through their spouse, for example, can you add an HRA? Yes. If you have an HRA, you can have an HRA with an annual limit that sits on top with, that integrates with a group health insurance plan. And if you have a group but you have employees that elect not to participate because they get their coverage through their spouse, can you add an HRA? Absolutely. That is called a spousal HRA, and lots of employers use a spousal HRA as a way to lower their own costs. They go to their employees and say, look, Mr. Employee, we know that you qualify to be on our plan, but your spouse is also employed and your spouse also has a plan. So we don't want to pay for double coverage. We would rather take our 105 plan and use it to cover any expenses that your spouse's plan does not cover. That way, Mr. Employee, you still get great health benefits, but we're not paying the cost of a second plan. Spousal HRAs have been a very valuable strategy as the cost of premiums have gone up. It used to be that when premiums weren't so high, employers didn't have to pay so much attention to the costs of plans. Now they can't afford to buy double coverage anymore. Member says, are S-Corp owners able to set up health savings accounts for themselves and their employees? Absolutely, and this is a great strategy for S-Corporation owners. If you've got an S-Corporation, let's say it's a realtor, and the S corporation is going to save a boatload of money on self-employment tax, the savings from a 105 plan probably wouldn't be as much as the savings on the S corporation anyway. So go ahead and buy a high deductible health insurance plan and set up an HSA and pay the out-of-pocket expenses through the HSA. You will avoid the 10% floor on itemized deductions for medical expenses without having to set up a separate entity to set up a Section 105 plan. Also, let's say you are an S corporation owner and you have 20 or 30 employees. You might have a high deductible group plan for your employees. You can also use a Section 105 plan, the way we talked about, as a wraparound plan to pay additional benefits on top of the group health plan. You can't participate in the plan yourself, in the 105 plan, so you might choose to buy high deductible health insurance for yourself and set up a health savings account. Can S corporation, and it's the exact same question, can S corporation owners, husband and wife, write off their self-employed health insurance and have a 105 plan for them and their employees? Can't have the 105 plan for themselves, because remember, they're not employees under the definition that we talked about at the very beginning of the hour. However, they can set up a 105 plan to cover their employees. Here's a member who says he got confused. Imagine that. Bill, join the club. Situation is a C Corp with 2 employees. They had a 105 plan for several years. The 105 plan has no limit for expenses. It has paid for premiums and out-of-pockets in past years. Employees qualify for premium assistance now and have bought new policies paying $495 per month with $700 of tax credit assistance. Can the premiums be paid through the 105 and all out-of-pockets as long as the 105 stays as a no-limit plan? Unfortunately not. If they want to take advantage of the premium credit under Obamacare, they're going to have to use their own after-tax dollars to do it. The employer can still have a 105 plan to pay the out-of-pocket costs. So they can do that. However, you've really got to look and see whether it makes more sense for the employee to pay the premiums with out-of-pocket dollars. In this case, if we're looking at a $1,200 premium, the employee is paying $500 per month of that and getting a $700 tax credit assistance, it's probably going to make more sense for the employer to simply add to the employee's paycheck than it is to set up a 105 plan and pay a $1,200 premium with all employer dollars. It's going to make more sense for the employer to say, you know what, I'm going to gross up your paycheck for you to pay the $495 yourself, and we're going to let the government cover the $700 a month. That's going to be more beneficial to the employee and to the employer to split it up that way. Your employee is going to look at you and you're going to say, wait a minute, I'm paying with after-tax dollars. Aren't I getting screwed here? And this is where you need to sit down with the client and maybe the employee and say, no, the tax benefit is X and the premium credit is Y, and we're structuring it so that you qualify for the premium credit because the premium credit is actually more valuable. So a member says, under the individual wrap concept, is there any way for the employee premium expenses to be paid pre-tax? Well, the employee who is paying a share of the premiums can pay through a Section 125 plan. They will not qualify for premium credits under Section 36. But depending on the employee's tax position and the employer's tax position, that is okay. All right, that's a mouthful. That is a lot of technical stuff, and as a guy who likes presenting webinars and likes explaining things on webinars, I apologize for the slides that are nothing but text out of that darned notice 2013-54. But it really is important that we parse the language of the IRS notice. We need to understand exactly how the notice defines a health reimbursement arrangement and why a health reimbursement arrangement is not the same thing as a Section 105 plan. Language matters when we're talking tax law, and speaking as a guy with a law degree, language matters. So when an irresponsible financial advisor, when an irresponsible employer or benefits consultant hears that Notice 2013-54 put limits on HRAs, they go out and they say, oh, 105 plans, MERPs, they're dead under this notice. Well, we need to understand that that's simply not the case, because the notice applies to a specific category of 105 plans, a subset of 105 plans that the notice explicitly defines and designates as a health reimbursement arrangement. But while all HRAs are 105 plans, not all 105 plans are HRAs. We simply have to understand that difference to be able to reassure our clients that the 105 plan is still alive and well. Nothing changed that 1954 law. The 105 plan is alive and well, and in fact there are more planning opportunities for you and your clients, not less. I really think that what's going to transform the small business group health market, and what may ultimately eliminate the small business group health market, is the availability of premium credits under Obamacare. For most employers and most employees, it's simply going to become more cost-effective, less expensive, to buy guaranteed issue individual health insurance on an exchange using a premium credit than it will be to continue to cover employees with underwritten small group health plans. We're starting to see it now, and naturally the group health insurance industry, meaning insurance companies and insurance agents, is not happy about this development. And if I was a group health insurance agent specializing in the small plan market, I would not be happy about this development either. But I would be working with my employees, I would be working with my employer clients to find the most cost-effective way to deliver the benefits that their employees are looking for. And that's what would preserve my business in a changing health insurance marketplace. A member asks, does the IRS audit and enforce Section 105 plans? Would that audit be separate from a regular income and expense audits? You know what? I have seen lots of clients get audited by the IRS and have the IRS look at the deductibility of a Hire Your Spouse 105 plan on a Schedule C. And that's why it's important that you be able to show that the benefits are reasonable compensation under the plan, that you be able to show that the money was actually paid from the employer, and that you be able to verify the bona fide employment of the spouse. On a larger scale, though, does the IRS come in and look at, do they audit employer 105 plans? I've never seen it. It really would be more of a Department of Labor issue. We're really talking ERISA law more than tax law, because the tax deduction is pretty straightforward. By the way, to those of you who worry that the IRS does not like Section 105 plans that reduce the cost of health insurance, when an employer pays less to cover their employee benefits, those savings drop to the bottom line and increase the company's taxable income. So the IRS certainly is not losing tax revenue when employers find solutions to pay less for their employees' benefits. Audience member says, can you force an employee to only buy a bronze or silver plan? Does this act as a limit? Otherwise, if it's unlimited, everyone would buy a platinum plan, wouldn't they? How does the employer get some cost guarantees? Well, the way they do that is they specify the benefit they are paying for in the plan, and they can specify that they are paying for the bronze plan. That will satisfy the minimum coverage requirements the employer will meet the Obamacare requirements. Remember, an employer does not have to give their employee a platinum plan. So they can specify the limit to the amount they cover under the plan is the platinum or the bronze plan, and they can limit runaway expenses there. All right, I'm pleased to see that we've still got 63 people out of the original audience of 105 here. That tells me that this is useful information. We will continue to update the Tax Coach resources. Dealing with Section 105, we're going to have a post-Obama updated 105 template implementation guide on the site shortly, as well as the template expanded 105 plan that I discussed earlier. Let us know what you think you would like. We're also working on a cheat sheet. It's not going to be a flow chart specifically, but it's going to be a sheet that you can use to sit down with an employer and identify some directions to look in, as in, should you consider dropping group health insurance and buy individual? Should you consider dropping employee insurance entirely and sending them to the exchange to buy with premium subsidies? We're having a tough time figuring out how to explain that concept with pictures, but we are looking forward to creating some pieces that you can use with your clients to counsel them as to their options under Obamacare. And you know that Obamacare is going to be updated next week, and the week after that, and the week after that. We will continue to bring you updates as those are needed. All right. Couple of final questions and comments. Thank you for those who've said it's a great webinar. Member says, should I tell them to have the employees pay their premiums, but it's still okay to reimburse for all other out-of-pocket expenses? You know, it all depends on the employees. It depends on the income. It depends on how old they are, how much the premiums would cost, how much subsidy they would be eligible for. This is when I talk about a cheat sheet that won't exactly be a flow chart, that's the question we're looking to help you answer. All right. Thank you all for staying. I'm glad that this was worthwhile time for you. Keep us posted with your successes and your frustrations. Let us know what works for you. Hopefully this information will help you work with your employees and ease their fears, particularly when they run into somebody who tells them that the 105 plan is dead under IRS Notice 2013-54. Hopefully I have blown down that big bad wolf and you need not worry about that again. All right, everyone. Thanks for your time. I really appreciate it. Hope it was worthwhile. You all have a great day, and best wishes building your business using this information. Thank you.